Good evening everyone, and thank you for your time. I've prepared slides for this evening's presentation, but what I'd really like to do is to answer your questions. So as John said, if there's a topic that you'd like us to address, please click on the little blue hand at the top of the screen and send your questions on through. So we all know that COVID-19 has had a huge impact on society, the economy and financial markets as well, and also the value of your retirement savings. A human health crisis has become an economic crisis, with direct and severe impact on so many people. We've been doing a great job here in Australia flattening the curve, even including the recent outbreak in Victoria, and it's such a contrast between the experience here in Australia and many places in the world. In the left-hand chart here on the screen, you can see the experience in the US, which has had a resurgence in COVID-19 infection rates since state governors have begun to reopen the economy. We're also seeing an ongoing increase in the caseload in many emerging market economies, such as Brazil and India. One thing's for certain, COVID-19 infection rates and mortality remain a very challenging aspect of our daily lives around the world. Treasurer Josh Frydenberg today announced the largest budget deficit in Australia's history, a consequence of the government's necessary response to the economic hibernation that we've been experiencing. And when you look at this chart of unemployment, it's easy to understand where that deficit has come from. Many people and businesses out there are struggling to make ends meet, and we can only imagine what the economy would be like without the government support programs, JobSeeker, JobKeeper and the rest. What we're seeing now is the highest unemployment rate for 20 years. And when we take into account people receiving JobKeeper but who aren't working any hours, the effective unemployment rate is greater than the recession of 1990. The effective unemployment rate reached almost 15% in April this year. That's an astronomical number. And shutdowns in the economy have damaged consumer confidence as well as the risk appetite of the average investor. And this damage can be seen most keenly in the prices that people have been paying for companies listed on share markets, both here and overseas. During February and March, share markets experienced drawdowns of 20 to 40%. The chart on the page in front of you here is the S&P 500, which experienced a peak to trough drawdown of more than 30%. And we experienced a similar fall here in Australia. This is the second fastest fall in share markets in history, leaving aside Black Monday in 1987. And this has caused understandable stress for many members. But it's clearly great news that share markets have bounced back, and bounced back hard. So much so that the US share market is now in positive territory for the calendar year to date. Here in Australia, we've also seen a hard bounce back in the ASX 200, and the economy has begun to recover as well. Now, part of the reason for that, of course, is the remarkable recovery in China, which you can see here on the chart in front of you. China remains our largest export market, and their ongoing demand for mineral exports in particular has supported our economy. The right-hand chart is the US dollar price of 62% iron ore. That's the benchmark used for pricing in iron ore. And the mineral exports that we generate through iron ore, through natural gas and other sources generate vital revenues for businesses. They support Australian wages and they help generate tax revenues for the government. So where did we finish up for the financial year? Tonight, I'm very pleased to report to you that LGIAsuper was one of only 16 funds to have a positive return for its MySuper option. All bar one of our diversified options finished back in the black this year. Now that may not sound like a big deal, but compared to where we were towards the end of March, that's really an excellent outcome for members. You can see from the right-hand column here on the screen that it's been a challenging period for share market investors, particularly here in Australia, and for property investors. For those in the positive territory, fixed interest in international shares, we've seen small positive gains, much less so in previous years. It's a similar story, of course, for our pension options. You can see the returns for the pension options are generally higher than those for the accumulation options. And that's because, of course, members in the pension phase don't have to pay income tax on those earnings. Just like the accumulation options, the bounce back in returns has been very pleasing for our pension members, and this will help boost their retirement outcomes. Members also often ask how we're doing compared to other funds out there. To make that comparison, let's have a look at the super rating survey This one's as at 30 June 2020, and of course all returns shown are after fees and taxes. For the year just gone, LGIAsuper's diversified options were above average returners, and the return for our balanced option in particular was number 4 in the survey for the financial year just gone, and that's a very pleasing outcome. Over longer time periods, here I've simply pictured 3 years, the story is much the same. When you invest with LGIAsuper, you're investing in a tried and tested investment strategy that's delivering above average outcomes for its members. The same's true for our pension options, but we're performing even better compared to peers here, with the aggressive, diversified growth and the balanced options in the top quartile for the financial year, and either top quartile or top of second quartile over 3 years. Pension members obviously better from this better than average performance through higher account balances, and this helps support their lifestyle and retirement. So as we enter the new financial year, a natural question to ask is, what does the next phase of the economic recovery look like, and what does this mean for financial market returns? Well, there's no avoiding the fact that a large part of the next 6 to 18 months is going to be dominated by 3 important factors. One's the US presidential election, the second is the trade tensions we see between the US and China, and the third, of course, it's COVID-19, and in particular, whether we get a vaccine or we have a second wave of infections and mortality. Now, if we do discover a vaccine in the near future and it's quickly developed and then distributed, that's a very positive outcome, and we're much more likely to see sustained pickups in economic activity around the world, and that should be very supportive for share prices. The flip side, of course, is that a delay in getting a vaccine or a continued escalation in infection rates and mortality is going to suppress demand and have a negative impact on the economy and likely a negative impact on share market prices as well. But the bigger challenge we see is the longer term picture, outside of that 6 to 18 months. We need to find a way to reinvigorate productivity growth and economic growth in the economy, not just here in Australia but around the world. Stronger economic growth delivers better profits for businesses. It supports wages growth and employment growth. These are all things that are necessary for Australia to continue to progress. Faster growth will also boost the housing market and other economically sensitive parts of the country. Without that extra growth, it's going to be a tougher time to businesses to invest and for consumers to spend their discretionary dollars. And this does help to frame where we are in financial markets, because right now we're getting very different signals about the future economic outcomes from share markets compared to bond markets. And I'd just like to spend a couple of minutes looking at that here. If I look at share market pricing right now, investors in share markets are quite buoyant. They're saying future prospects for the economy are quite positive. They're looking beyond the current circumstances that we find ourselves in, and they're choosing to pay higher and higher prices for future profits. This apparent contradiction, rising share prices and yet we see falling earnings at the present time, comes about precisely because share market investors tend to be forward-looking. They're trying to look beyond the current circumstances out into the future, and they're forecasting much better times to come. In fact, the mood of share market investors is at risk of being perhaps a little bit too buoyant. As you can see here, this chart of the Shiller PE ratio simply talks about the price that people are paying for $1 of future profits on the share market. Now, we're close to record levels on this measure. What does that actually mean? Well, it means it's going to be tougher in the long term for share markets to generate significant capital gains, given the high prices that investors are now paying for profits. And we can see this best in the performance of a component of the share market, and in particular, the dichotomy between so-called growth stocks and value stocks in the current market. This chart from Goldman Sachs shows the performance over the last 6 months of growth stocks. Let's talk about Facebook and Google and Amazon and Apple, Microsoft, Netflix, and how strongly they've outperformed old-fashioned value stocks, industrials, mining companies, banks, and that outperformance has accelerated. Now, this is atypical behaviour coming out of a recession. Normally that boost in economic activity that you see coming out of a recession gives those value stocks a real kick along. We're not seeing that. In fact, we're seeing the reverse at the present time. Bond markets are also talking to us about a very different story to share markets. It's a message of caution about the future. And what I've got on the page here is the expected return on 2 types of US government bonds. At the bottom, this is a US 10-year government bond. That's the plain vanilla standard type. But at the top of the page, I've got the return on a very different kind of bond. This one's a so-called inflation-protected bond. Expected returns from bonds are low. In fact, they're so low that investors in bonds are going to lose money once they take inflation into account. And in fact, the expected returns have continued to fall since March. And again, that's a very different outcome to what you would normally expect from an economy that's bouncing back after a recession. Expected returns for bonds are very low, but they're also very low for cash. In some places in the world, cash returns are actually negative. This isn't the world that I grew up in. I'm old enough to remember when cash and bonds used to pay such a high income, members could retire and invest in these so-called low-risk assets and simply live off that income. That would be an extremely difficult thing to do in the current circumstances. So what does that mean for us going forward and you as a member? The world faces a high degree of uncertainty about economic and financial market outcomes, and a natural question to ask is, what are we doing in response to these challenges? That is a great question, and I'd like to address it here this evening. What we're doing here at LGIAsuper is relied upon tried and tested techniques that have been put to work over decades to deal with challenging times. What am I talking about? What we're showing here is the MySuper under 75 option, where most of our members are invested. LGIAsuper is a big believer in the benefits of diversification, spreading your risks across different types of investments. And the reason is that investment professionals will tell you that diversification works. Diversification helps to reduce the risk that you see a really bad outcome from any particular type of individual investment. The MySuper strategy that we offer members here is a growth-oriented one, but it's diversified both within the growth assets and between growth and defensive assets. Diversification provides you with the best possible chance to meet your investment goals. We're also staying focused on the long term and keeping a long-term perspective on the world. That helps us to maintain a long-term investment plan, and it minimises the risk that we make big changes in the portfolio at the worst possible time. We're also reducing fees, costs and taxes in the plan. It's always a good time to squeeze more value from the assets you already own, to reduce costs and to focus on generating returns in an after fees and taxes concept. That's always going to be a big part of the response here in the investment team. And from a member's point of view, the start of a new financial year is an ideal time to do a little health check, to review your personal circumstances, and that includes looking at your super. Members who stay informed, who ask questions and get advice, whether that advice comes from us or from another trusted advisor out there, tend to get better retirement outcomes, and they're in a better position to achieve their retirement goals. So as always, if you have any questions, please just let us know. Click on the little blue hand above, send your questions on through, because we'd love to help. Thanks again for your time this evening.